friends, welcome to our channel Create Your Wealth. Our today's topic is multi-baggers. Everyone who is currently investing in the stock market is hoping that the stock they have picked up or they are holding turns out to be a multi-bagger. What is a multi-bagger? A stock that doubles its price is called a two-bagger, and if the price grows 10 times, it's called a 10-bagger. So in simple words, any stock whose price have risen multiple times is a multi-bagger. So my question is, are all good companies multi-baggers? Yes, they are if you bought it at the right price. However, they generate losses if you bought it at higher levels. So buy them at the time of high pessimism to generate multi-fold returns. Take the example of Jubilant FoodWorks. A couple of years back, the stock was trading around 1400 levels, but due to poor sales number and profit, the stock price declined from 1400 levels to 900 levels. And around the same time, Ajay Kaul, who was the CEO for 11 years, had resigned. There was a lot of negativity in the stock as many brokerages were recommending a sell and were suggesting a price target of around 700 rupees. But if you had conviction and if you like the operating model of the company, that was the right time to get into the stock. As right now, the company's share price is trending around 2700, which is its all-time high. So you need to buy a stock if you like the company, but buy it when there is a lot of negativity. How do you look for a multi-bagger? Well, there are quite a few criteria that you need to keep in your mind when you're buying into such stocks. You can buy a company in a new industry that is early in its life cycle, or you can buy a company in an industry that is experiencing a positive change. You can take the example of HEG or Graphite. Both have given returns of 200 to 300% in the last couple of years. These companies manufacture electrode, and they have given this rise or this profit as China is now shutting down electrode manufacturing companies due to the pollution. So any company which is not complying with the guidelines, all such companies are being closed in China. And because of that, the electrode price across the globe has risen from $7,000 metric ton to 11,000 metric ton. And this has impacted a positive impact on Indian companies as well. Like HEG has reported 26% up sales and 636% rise in EBITDA. The other example that you can see about the positive change is the reduction of the interest rates. With RBI reducing the interest rates, you see that a lot of banks, NBFCs, car manufacturing companies, banks and home loan lending companies have given huge profits to its investors. So the other option or the other criteria that you can keep in mind is to buy a good company when there is a panic in the market. As you would have noticed that in last 5 to 6 months, a lot of small cap and mid cap companies have corrected to about 50 to 60%. So if you know, or if you've identified a good fundamental company, then this is the right time to get into good stocks. The other criteria is that you buy a strong company with a proven capability but experiencing temporary problems. Always remember that even the best companies in the world cannot deliver outstanding results every quarter. Due to various market conditions or execution related problems, good companies sometimes have bad quarters. Even if the management team of the company has demonstrated the ability to generate profits and sales, the market tends to punish the shares of such companies in bad times. Bata, being one of the most consistent performers, had problems when they moved to a different ERP. They started having problems due to supply chain issues, and because of that the sales figures were impacted for 2 to 3 quarters, and the stock price had corrected by 50%. So that was the right time to get into a stock if you had trust in the management. Let me tell you that now Bata is trading around its 52 weeks high. The other criteria is exiting. Identifying and holding a multi-bagger are difficult. However, the sell call is the most difficult and challenging, as getting rid of or selling such stocks is always a difficult step because the factor of greed comes in. So take the example of all sugar stocks, which gave a return of 400 to 500% during a period of 2015 to 2017. However, now all these stocks are trading at their 52-week low. So if you had bought such stocks in around 2015, you would have definitely made some money. But if you have not sold those stocks, then you have not made any gains. So it is absolutely important that you exit from the stocks at the right time. To summarize, multi-baggers are not for everybody. While some exposure to potential multi-baggers can add return to average portfolio, these opportunities are ideally suited for those people who do not have to worry about the cash that they have invested in such companies. So please keep these criteria in mind if you're looking to invest in any stock that you want it to turn out to be as a multi-bagger. Friends, if you've liked this video, then please share it and comment and like, and you can subscribe to our channel. Also friends, we are going to conduct a free webinar on 8th of July on the basic fundamentals of the stock market. For more details, you can log on to www.createyourwealth.com. Thank you.